What is up, everybody? Jay Costa here. Welcome back to the channel. Today I wanted to share with you the latest on mortgage rates and the housing market. In this video, I will share with you where mortgage rates are currently. They are up substantially. The effect these higher mortgage rates will have on the housing market, as well as my forecast on the housing market going forward in both the short, the medium, and the long term. But first, before I get started, you guys, I want to thank you so much for tuning in and watching this video. If you get any value or enjoyment out of this video at all, please smash that like button down below. I would truly appreciate it. It really helps me grow on YouTube and gain viewers just like you. If you didn't already know, my name is Jay Costa, and I'm a real estate agent and investor here in Northern New Jersey. I am out in the fields every day getting a pulse on the market here in Bergen County, New Jersey, as well as keeping a very close eye on the national housing market as well. As a real estate YouTuber, I frankly feel like I need to say either one of two things. One, the housing market is about to crash tomorrow, or two, it's never a bad time to buy real estate. Buy, because the real estate values can never go down. We know neither of these is true. And frankly, I'm getting a little tired of the real estate YouTubers out there coming out with a video every single day saying the same thing over and over about an imminent housing market crash. This is panic porn, put simply, in order to scare you and in order to get views and clicks onto your video. Now, that's not to say that there's not legitimate concerns for the housing market. So on the other end of it, don't listen to every real estate agent out there either that says that now is a great time to buy no matter what. With mortgage rates where they are at currently, we'll get to that in a second, as well as the all-time high housing prices, now is maybe not the best time for many people to buy out there. The truth is, nobody knows. I don't know, you don't know, they don't know. So all we could do is follow the current data, compare it to past precedent. That way we can make the most informed decision, and you can make the most informed decision on whether you want to buy, you want to sell, or you want to rent for you and your family in this housing market. Okay, so let's get started. The 30-year mortgage rate, according to Mortgage News Daily, is now up to 5.25%. That is the highest it has been since 2009. We all know what was happening in 2009. This is pretty staggering stuff. So on average, the current homebuyer's mortgage payment just went up 38% compared to this time last year, and that's just based on the increase in mortgage rate. That's not even taking into account the price appreciation over the past year of another 15+%, depending on where you are. So where does this put us in the current housing market? Well, the problem with real estate data is that most of it is lagging. By this, I mean that the homes that are closing right now today, they went under contract probably 30 some odd days ago, and they probably were listed 45 to 60 days ago. 60 days ago, the interest rate was at 4%. Now we're at 5.25. That's over a 1%. That's 1.25% difference just in the last 60 days. So the data from 60 days ago is almost not relevant at this point. So if you look at the standard housing market data points like median sales price, average days on market, etc., most are unchanged from their previous trajectories and previous trends, which is values up, days on market down. But we all know that interest rates cannot go up this much this quickly and not have an effect on the housing market. Many real estate agents out there pretend to be Milton Friedman and cite supply and demand as the reasons that they have no real concerns over the housing market. But here's the thing, if the current home buyer's mortgage payment just went up by 38% just based on interest rates, that affects demand. Less demand at the very least means a more even housing market, at least in theory. So unless interest rates drop from here, which is highly unlikely, the housing market will be affected going forward, guaranteed. So here is my forecast. As I stated, the higher mortgage rates will dampen buyer demand substantially, which has been at all-time high levels. Normally when demand cools, when prices are at all-time highs, you'll get a wave of FOMO sellers trying to put their house on the market for inflated prices after seeing that the housing market may have already peaked. And given the current situation and current headwinds that we're currently facing in the housing market and the general economy as well, I do believe that the housing market has peaked value-wise, at least in the short term. But here is the problem. Here's the situation that we're in right now. The interest rates have shot up so high so quickly. If you're a seller looking to put your house up on the market, you're probably paying 2.5% to 3.5% on your current home that you're trying to sell. If you bought it or refinance it within the last 2 years anyway, which most people have, you would be selling your home where you're paying a rate of, let's say, 2.99%. You'll put it on the market, you'll probably sell it for a pretty high price, but then the problem is, what do you replace it with? You would be replacing it by purchasing another home, paying also a very high price for said home, but you're paying with a 5.25% 30-year mortgage rate. Your monthly payment would be up substantially from your previous home. So it really would need to be worth it in order for you to move. Like for someone who's looking to move out of state or for family reasons or something like that. You would be paying more per month for your new home than on your old home. And this is before you're even spending money on any furniture, appliances. You want to make it your own home just like you did the last one, right? That takes money as well. So I think many sellers are just going to say F it and stay where they are, just like they have been. So that projects to be a pretty stale and slow housing market for the next, let's say, 3 to 6 months. But what about mid to long term, like 6 months up to a year plus? We can go one of two ways. Either A, the Fed threads a needle on inflation, is able to get inflation under control, allowing them to reduce the interest rates again and allowing the housing market to trend upwards just like it was, let's say, pre-pandemic. Say around a 5 to 7% annual appreciation on your property. Or B, inflation continues to spike and the Fed cannot get inflation under control without causing a recession. And that right there is what could potentially cause a collapse or a crash in the housing market. As of right now, we have about a 28% chance of a recession coming soon. So this forecast by me is in no way to scare you or frighten you from buying or selling or investing in real estate at all. But it's a pretty good possibility here that we need to be aware of in this housing market. After 2 years of free money in PPP loans, stimulus checks, and the most money printed in the history of the country, U.S. consumer sentiment is at its lowest level in 10 years. Americans are already feeling the pinch of inflation in gas prices, utility bills, and costs of goods and services and food. Many are already pricing in a potential recession and started to cut back on discretionary goods and purchases in order to balance out the increase in living expenses. U.S. consumers have been spending hand over fist for the past 2 years because money was cheap and sometimes even free. New kitchens, houses, decks, cars, Pelotons, everything. You name it and Americans were buying it. But now that the gravy train is over, I'm concerned that the decrease in consumer demand is going to be a self-fulfilling prophecy and lead us into a recession. Now, historically in the US, recessions have not been an end of the world scenario. We used to have recessions every, let's say, 6 to 9 years, and they would last maybe 6 to 9 months, and we would get back on track after that. But we haven't had a recession since the Great Recession of 2008. So I believe that most Americans are in either one of two camps as usual. Either one, they think that the next recession will be as bad as the 2008 recession, or two, they are either too young or too naive to remember how bad 2008 was. So even with the equity levels at all-time highs for the average home, I believe a recession would quickly unmask what Americans have been doing with this cheap and sometimes free money. Hopefully they have not overspent, overextended, and over-leveraged on their monthly expenses, leaving them up Shit's Creek if they somehow lost their job and were not able to find a new one. That is it for today, guys. Thank you again so much for watching. Let me know what you think about the housing market and what I share with you in the comment section down below. Where do you think the housing market is going from here? What effect is this 5.25% mortgage rate gonna do to the housing market short, medium, and long term? And also mortgage rates in general. Do you think that they're gonna stay around this price, or do you think we're going up to 6, 7, 8, 9% mortgage rate on a 30-year? And what would that do to the housing market? Like I said, appreciate you checking in. I will catch you next time.